Hi there, welcome to Kneppy Invest. When I started investing well over 10 years ago, I had probably the most important choice or decision that the new investor has to make. What is the first company to put your money into? Now, these days, a lot of new investors put the money just into ETFs. Back then, ETFs weren't a big thing. So I decided upon Commonwealth Bank. That was the first company. Second company was BHP. So there is a common theme of these two companies, two of the biggest companies, if not the two biggest companies on the ASX. Now, I knew Commonwealth Bank a little bit because I actually worked for the Commonwealth Bank. In fact, it was my first real job after I finished university. I worked with the bank for just over 1 year. Now, just because I worked for a bank doesn't mean I'm a banker, and it doesn't mean I'm comfortable analyzing banks. And in fact, even though Commonwealth Bank was my first investment, I eventually sold out of the bank maybe 5 years after I bought in. Nice capital gain, some nice dividends. But I have never, ever since I've started investing, never have I delved deeply into looking or analyzing banks up until right now. Now, to be honest with you, as I did start this little project on researching Commonwealth Bank, and when I say researching, I haven't gone too deep into the bank. I was initially a little bit confused about exactly what sort of metrics, what sort of things I should be looking for. And what I did is I went to Reserve Bank of Australia. Now, there was a nice little article that was released in April 2022 called The Australian Financial System Financial Stability Review. And this talks about some of the metrics uh, that probably investors should be looking at when it comes to banks. So I'll be looking at some of these metrics. I might be ignoring some metrics that more advanced, seasoned investors would look at when they do analyze banks. So in today's video, I'm going through the financial year 23 results for the Commonwealth Bank, and it is a little bit more detailed in terms of odd metrics compared to most other companies on the ASX because this is a bank, and banks are a little bit different than other companies that we might invest in. Now to Commonwealth Bank's financial year 23 results. Starting off with two things I look for or look at for every single company. Revenue, which is actually the first thing I look at, 27.5 billion, which was up on the previous year, up about 12 or 13%. Profit, 10.1 billion, up 5% on financial year 22. But if you break their profit into two halves, the second half profit was down a little bit from the first half profit. Now on to some metrics that you probably only see in banks. CET1, which is Common Equity Tier 1, 12.2%, which is up a little bit, 10 basis points on the first half of financial year 23. Now, based off this article I did read, banks, particularly the big banks, are required to have a CET1 of 10.5. It looks like that has risen. Smaller banks is a little bit lower, about 8. Now, it seems like CET1 is a very important metric for banks, just based off the research I have done. It shows the strength of the bank, and particularly that strength is important when there's some black swan event. Now, in saying that, Silicon Valley Bank had a fairly strong CET1. So just because you have a CET1 that is fairly high, that is in the range where you want it to be, doesn't mean necessarily the bank is 100% safe. NIM, and this is one metric I knew was very important for banks, that is net interest margins. That is at 2.07%. Now, that was up 17 basis points from financial year 22, but down 5 basis points from first half of financial year 23. And that is pretty good. I did compare that net interest margins to other banks around the world, and that actually is a fairly good number and about similar to other banks or big banks in Australia. Financial year dividend, this is very important for a bank because I would say that most shareholders in Commonwealth Bank are shareholders because of the dividend. $4.50 dividend, which means because the share price is around about $100 right now, that means the dividend yield is around about 4.5%, which is interesting because potentially you could put your money into a savings account in Commonwealth Bank and possibly get interest on that savings around about 4.5%, or maybe term deposits, that sort of thing. I doubt you'd probably have a savings account getting 4.5% interest, but there is a potential that you could have a less risk investment in banks where you get higher returns than 4.5%. And the reason why the dividend is important, because you won't see much capital gain in the future when it comes to Commonwealth Bank or any of the banks. In fact, the other three major banks' share price has actually decreased over the past 10 years. So the dividend and dividend yield are very important for the banks. Return on equity for Commonwealth Bank up at 14%. I had to be very careful there because, in fact, over the past 10 years, return on equity has actually decreased for the bank. Now, when I went through their presentation, there were some really interesting slides. So I'm going to actually show you some really interesting slides when it comes to Commonwealth Bank, not only Commonwealth Bank, but also the economy at large. Equity, $72 billion. Now, equity is important for the banks. This is just assets minus liabilities. And one of the problems with Silicon Valley Bank is because they had a lot of deposits which they didn't know what to do with. And they couldn't give those deposits out as loans. So they decided to put a lot of those deposits into bonds. And then the value of bonds had to be decreased because, don't forget, when bond yields start going up, bond prices start going down. So they had to revalue those bonds. So equity went down. And that was really the start of the problems for Silicon Bank. Now, more than likely, Commonwealth Bank won't have those problems. In fact, most Australian banks won't have their problems because Silicon Valley Bank was a unique situation. Deposit funding ratio. I found this really interesting that with their loans that they give out to homeowners, that sort of thing, 75% of that funding comes from deposits, which really intrigues me, that they are able to get so much deposits that they are able to give those deposits back as loans. 75%. I thought they would have been much lower. And we actually have a look at that history of deposit funding ratio over the past 15 years. It has gone up a fair bit. Shares on issue, 1.68 billion. And the market cap of Commonwealth Bank, depending on the share price, 166 billion. And the share price right now is around $100 as I am recording this on the 23rd of August, 2023. Now to the valuation of Commonwealth Bank. And this is the premium bank in Australia, if you don't include Macquarie Bank. So there has always been a premium to the Commonwealth Bank. And the P/E ratio of 16.4, I think, was a little bit high. But I'll show you the historical P/E ratio for the Commonwealth Bank over the last 20 years later in the video. And right now, I think we're in sort of the mid-range. So I wouldn't necessarily call Commonwealth Bank right now expensive or cheap. Price to book ratio, 2.3, and that is probably a little bit higher than what I would like. But again, there is a premium to Commonwealth Bank. Dividend yield, 4.5%, that's pretty easy. And one of the ways I would see myself take a position in Commonwealth Bank is if I see the dividend yield fairly high, which more than likely would mean the share price would have to drop from here. If I saw the dividend yield get to, say, 8%, I would consider taking a position in this bank. Now, also did a reverse DCF. Now, you have to be wary of reverse DCFs, particularly for companies that pay a lot of their lot of dividends, because that reverse DCF, it doesn't take into account dividends. So to justify the current valuation, earnings per share would have to increase at 10.7% per year. Now, if you take into account dividends, you might actually achieve that sort of return. Now, we'll look at the historical return over the past 10 years of Commonwealth Bank. It's not quite as high as 10.7%, but it's getting up there. Now let's have a look at some interesting slides I found in Commonwealth Bank's presentation. The first one here is looking at CBA over time, and they've just said here in the title, larger, safer, lower probability, or profitability, not probability, profitability. Those last two words are very important, lower profitability, but they are larger and safer. But this means don't expect significant increases in profitability. Commonwealth Bank is not a growth company. So size of the company, it's grown. Gross loans are up 53% from 2014 to 2023. So they're comparing June 2014 to June 2023. So gross loans up 53% over the last 10 years. Total customer deposits up 87% to $819 billion. Gee, that's a lot of money deposited in Commonwealth Bank. Strength CT1s increased from 31 billion to 57 billion, up 84%. Liquid assets, which is actually really important as well, up 36% to 189 billion. Now onto profitability. So return on equity down from 19% to 14%, down 26%. And profit has gone up, but has only gone up 17% over the past 10 years. So the main thing about the Commonwealth Bank and all the other major banks, 3 major banks, is don't expect profit to increase all that much over the next 10 years. And there are some extra reasons why I think profit will struggle to grow for Commonwealth Bank. Now to a slide that is not really Commonwealth Bank specific. This is looking at the overall economy, because whoever decided upon this slide decided what they're going to do is separate Australians into different age groups and look at the effect of rising interest rates on those age groups. And they're looking at home loan balances, deposit balances, change in savings, and change in spending. Now, just knowing certain things about different age groups, we know that those more likely to have mortgages would be between about 25 and 45. Once you get above 45, you're more likely to own your own house outright. So those aged between 25 to 45 are more likely to be affected by rising interest rates. And that bears true when we look at this particular slide, particularly the last two, change in savings and change in spending. In fact, those aged 65 plus have seen a significant increase in their savings and are spending that increase in savings. In fact, when you look at the change in spending over the last 3 months and 4 weeks, those aged 65 plus are spending big. 6.4% increase in spending over the last 4 weeks. And then it decreases as you get to the younger age group. And then when you get to the age group between 25 and 34, so those are those people who have bought probably a mortgage in the last 10 years, are not quite at the point where they're moving up the corporate ladder, so their wages have been significantly increased. And their spending has actually decreased over the last 4 weeks, down 0.7%. And not only that, change in savings down 3% on last year. So it really seems like those aged between 25 and 34 are those the ones being more negatively affected by rising interest rates, which makes sense when you just think about it for 1 or 2 seconds. And this is one of the reasons why I don't like just raising interest rates to solve inflation. I think there has to be other ways to solve inflation, because it really only affects certain age groups and certain people. Now, it's a really interesting slide in their presentation. This is on group margins. So I took a lot away from this particular slide because the group margins for Commonwealth Bank actually fell 5 basis points over the past half year, from 210 to 205. And the main reason behind the drop in group margins is competitive pressure, particularly in domestic home loans. And we are seeing, Commonwealth Bank is seeing a significant increase in competitive pressure over, say, past 5 to 10 years. There are more players in this area, and potentially we're going to see competitive pressure increase over the next 5 to 10 years. However, in saying that, there is one scenario where competitive pressure might drop, and that might be favorable for Commonwealth Bank. And that's in the scenario where we go into a significant, really deep recession. More than likely, Commonwealth Bank will survive that deep recession. If it doesn't, we're all in trouble. But what would happen during a deep recession is a lot of the competitors of Commonwealth Bank might fall away, might go bye-bye. And then when we come out of the recession, there's much less competitive pressure. And that is the time to get excited about Commonwealth Bank and probably the other 3 major banks, if they make it. There were also some negative effects on group margins by deposit switching, increased deposit price competition, and higher wholesale funding costs. They've also mentioned here financial year 24 considerations, intensity of home loan and deposit price competition. I think that intensity could increase rate of customer deposit switching. So more than likely, because of higher interest rates on deposits, we will see, I probably would suggest that Commonwealth Bank's interest rates on their deposits, their saving accounts, is probably among the lowest. And you will see depositors finding some really good interest rates on their deposits, some good term deposits, that sort of thing. So if they don't solve that, we might see more people take their money out of Commonwealth Bank and put it into ING or someone else. Higher wholesale funding costs and outlook for cash rate, replicating portfolio, and equity hedge. Another interesting slide I found was on page 32, funding. Where does Commonwealth Bank get their funding for their loans? So 75% is through deposits. And that has actually increased 20%. Well, actually not 20%, but has increased from 55% in 2008 to 75% in 2023. 18% through long-term funding and only 7% in short-term funding. And that has significantly increased from 26% in 2008 down to 7%. So the very fact that a lot of their funding comes from deposits is a good thing, because that means they do have sort of a control over their net interest margins. Not complete control, but I would be concerned about short-term funding, because interest rates on short-term funding can be quite volatile. Even long-term funding can be quite volatile as well. And one of the things I've been thinking about over the past 10 years is, because we do have an inversion in bond yields, and those banks or those institutions who borrow short and lend long might be really negatively affected by that. So it seems like Commonwealth Bank will be less negatively affected by that inversion in the bond yields, because not much of their funding is short term, only 7%. Now on to the quality of the Commonwealth Bank. So this is something I do for every single company. And I look at the last 10 years of financial history, and then I decide on the quality of the company just based off revenue growth, earnings growth. I also look at return on invested capital and return on equity. So revenue growth has been mediocre for Commonwealth Bank. So this is revenue per share, only increasing at 1.4% per year. Now, that's fair enough, because I would not consider Commonwealth Bank or any of the banks to be growth companies. The only reason I would invest in the banks is if I see the share price significantly lower than what it is now, and then you would expect a bit of a capital return plus some dividends. So that's the only way I would buy Commonwealth Bank or any of the banks, is if I see the share price decrease from, say $70, $80, something like that. Price has increased, this is just the share price, from $68.86 to around about $100. So it's only about 3.7% increase in the share price over the past 10 years. But the main reason people invest in Commonwealth Bank is not because of share price appreciation, it's because of dividends. We'll talk about that in a second. Earnings, which is earnings per share, from 5.2 cents per share to 5.86, so 1.2% increase per year. So again, earnings per share growth is just not there. It's quite mediocre. Dividends have increased from $3.99 back in 2013 up to, or 2014, up to $4.50. So not much of an increase in dividend. Now that 8.5% is not the CAGR of dividends. That's the overall return you have seen in Commonwealth Bank over the past 10 years. So that's taking into account share price appreciation plus dividends. And to be fair with you, 8.5% is about market average returns, which is fair enough, because Commonwealth Bank is one of the biggest, if not the biggest company on the ASX, maybe second biggest. And if Commonwealth Bank does really, really well, it means that other banks are doing really, really well as well. And that means the overall stock market is doing really well. If Commonwealth Bank and other banks really underperform, there's more likely that the overall stock market in Australia also does mediocre as well. So 8.5% is an okay return if you like stability, safety, if you like dividends, so a bit of income. 8.5% is not average sort of returns you might see in an ETF. One of the main things I look at when I am doing any bit of research, tiny bit of research on the banks, is to look at what the P ratio or the price to book ratio is right now compared to historical ranges. And the only time I have taken position in banks in the past 10 years this is way after I first bought some Commonwealth Bank shares, is when I see the P ratio or the price to book ratio of a bank on the low side, at the bottom of historical ranges. So in the next two slides, I'm going to look at the P ratio and price to book ratio history of the Commonwealth Bank over the past 20 years. So we can just compare the P ratio or these two ratios right now compared to where we might see them in any normal circumstances. Now, it's quite noticeable that during the two recessions we have seen, the P ratio of Commonwealth Bank fell down quite low. During the GFC, the P ratio for Commonwealth Bank was as low as 7. That's the time to think about buying into the banks. And then it recovered quite well. Even during the COVID-19 financial panic, the P ratio of Commonwealth Bank fell to about 10.5. But over the past 20 years, we can see the P ratio of Commonwealth Bank hovering between about 13 and say 19. We'll say 19, because only for a very brief period of time did the P ratio of Commonwealth Bank go above 19 and then fell away fairly quickly. So right now, it's at about 16, right in the middle of that range. So again, I wouldn't necessarily call Commonwealth Bank right now expensive or cheap just based off the P ratio and the P ratio history of this company. But if I saw the P ratio of Commonwealth Bank get below 13, that's when I would become excited about possibly buying shares in this company. If I saw the P ratio of Commonwealth Bank get less than 10, I'd become extremely excited about taking position in this company. So we're talking about the share price of Commonwealth Bank going lower than, say, $70. That's when I might become interested in this company and take a trading position. And I do the same thing with the price to book ratio. So typically, price to book ratio of Commonwealth Bank hovers between about 1.8 and 3. And right now, it's right in the middle of that historical range. And just like the P ratio, if I saw the price to book ratio of Commonwealth Bank fall below about 1.8, that's when I would become interested in taking a position in this company. And again, just like the P ratio, the bottom in the cycle for Commonwealth Bank's PB ratio is during recessions, during those tough times when the overall market gets a little bit nervous about the banks. Now on to the share price history for Commonwealth Bank of Australia. This is a weekly chart going back 10 years. And you can see the share price right now is around about $100. And to be fair, share price has been going sideways for over the past 2 years, trading between about $110 and as low as 90, got as low as about $88 back in June 2022, but really has been struggling to get below $94. So it seems like where the share price gets to about $94, there's a little bit of interest, a little bit of buying in Commonwealth Bank shares. And when the share price gets above about $108, we do see a little bit of selling. But if you do look at the last 10 years, generally, the share price has been creeping higher. And this is one positive thing about the Commonwealth Bank compared to the other banks. There is a bit of a premium attached to Commonwealth Bank. So there is a belief that this is the better quality of the 4 major banks. And that's why you do have to pay a little bit of a higher P ratio for this company, a little bit of a premium because of that perceived higher quality. And you can actually see that when you compare the charts of all 4 major banks. Commonwealth Bank's share price has actually increased over the past 10 years. The same thing can't be said for the other 4 major banks. Now, that does not mean that the 4 other major banks are better buys than Commonwealth Bank, just because, again, I think Commonwealth Bank is high quality, better management, and I think definitely over the next 5, 10 years, there is better potential that Commonwealth Bank will grow, albeit slow, but will grow compared to the other 4 major banks. That's all I have for this video looking at Commonwealth Bank's financial year 23 results. There were a few metrics I did not look at, including liquidity ratio, but maybe I can leave that for another video. If you are a Commonwealth Bank shareholder, if you intend to remain a shareholder forever, I'd love to hear your opinions on why. So if you disagree with me and you do believe this is a high quality company, also like to hear your reasons why, because our opinions can differ. Doesn't mean we're both wrong, doesn't mean we're both right, but opinions do differ. And the way we learn and grow as investors is to listen to different opinions. So if you do have a different opinion than myself, leave your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.